Welcome to the Daily Update, where we will go over things for Friday, January 21st, and then we'll see how things look for Monday, January 24th. It was a pretty negative day. We could have seen a bounce on Friday, and there was an attempt at a bounce on Friday, but it just didn't follow through. When that bounce did not materialize, which could have been justified based on the technical picture we're looking at right now, things did fall back, and we're looking even more oversold on a short-term basis, and we're starting to even look oversold on an intermediate-term basis. So just to go over what happened on Friday, we did have a negative open, which that's been really the pattern this past week. If we see a positive open, we see selling. If we see a negative open, we see some buying. And that's very common to see. We found support at S1 for Friday's session, and it looked like that was going to hold. And there was a bounce that was attempted, but we hit up at the resistance level. Now, on all the pivot points that we calculate each day, we have R1, R2. I don't usually display R3. That's for the really big move days. And then S1, S2, and the same with S3. I don't usually show that on the chart. I calculate those, and if we start to get into those areas, I will put those on the chart. But most of the time, we stay within R1, R2, S1, S2. However, the unchanged level is kind of a built-in support or resistance level. And we saw that on Friday. Prices started to go down to S1. They came all the way back up. It looked like there could have been some kind of rebound in the making, but we went all the way up to the unchanged level, and that's where things started to turn around and go back down. Selling resumed as the day went on, and once it was pretty obvious, at least in the early part of the day, that the bounce had failed, we went down through S1. That had acted as support previously, but we failed at that level. And then going into the close, we saw continued selling. There was a lot of momentum, and we ended up closing right at the lows for the session. So we were down 1.89% overall. The charts do show that we are in a downtrend now, and I'll confirm that with the charts that I'm showing you on the short-term basis, and we're starting to look more oversold in the intermediate term. The long-term trend is still holding up. And in the longer-term video that I do each week, we're still looking okay. Not great. There's been some technical damage that's been done, but the long-term trend is still holding up. Of course, you have a lot of the doom and gloomers that they say the bull market's over, get ready for the world to end, we're crashing from here. That's actually a good sign, because a lot of these real pessimistic people that I follow, they're usually 100% wrong. Okay, they're right. I shouldn't say 100%. They're right just enough to justify their conclusions, but they're always pessimistic. Before we've had big swings going up, they said, oh, it's over, time to get into gold, forget the stock market. Well, that usually marks some kind of a bottom. Doesn't mean that that's what's going to happen this time, but in the past, when they're very confident that this bull market is over and we're starting to head down, that's usually been the time when we've seen a nice rebound. And in a lot of cases over the last 2 years, we've gone on to hit new highs. We don't know if that's going to stay that way this time, because we're in a slightly different environment. Over the last 2 years, during the whole lockdown, we saw real weakness and stimulus going into the market and a real pump up of stocks. Well, now that the economy is starting to get back on track, we're more in an interest rate rising environment. It's not as monetarily friendly, and that's shifting things. So we're seeing a real move, continued move from the growth stocks over into the value stocks. Volume was above average on Friday, which should not be surprising because it was options expiration, at least for the monthly options and a lot of the weekly options. And the market is fixated now on weak technicals. If you look at any particular chart, I watched a few other videos, and everybody's pretty pessimistic about this. Doesn't mean I'm not pessimistic either. It just means that I look at both sides at the same time. We're also in the middle of earnings season. The markets are still fixated on inflation and interest rates, which was kind of interesting because interest rates actually came down a bit Friday, but stocks went down also, and I make note of that later. And there are some geopolitical concerns. We have this whole Russia-Ukraine thing that may be developing, and how things play out could have an impact on the markets. Some of the comments that we can make: there was a continued broad-based selling on Friday with no rebound. In Thursday's video, I said, yeah, it looks like if we're going to have a rebound, this would be a good place to have one. Well, that didn't happen. So we saw renewed or continued selling. Buying the dip has been unsuccessful because the idea is that you look for a little bit of a pullback, you get in, and then you make a nice little profit. And that's worked for the last couple of years. Well, at least this past week, that hasn't worked. What we're seeing is more selling into strength right now. On a technical basis, and I'll show the chart, the different charts that I have, we did close below the 200 simple moving average. Some people really like simple moving averages. Other people like exponential moving averages. I use them both. And we're right about at least on my charts, at the 200 exponential moving average. We kind of took a stand right there at the close on Friday. And then, as I mentioned before, interest rates declined on Friday, but stocks did as well. Earlier in the week, we saw more of an inverse relationship. If interest rates were going up, stocks went down, and vice versa. Well, they both went down on Friday. We are still overvalued as far as the current levels of the stock market. We are in a negative trend now, and of course, the bias continues to be negative. So let's look at the day's session. First, at sentiment. We're going a little bit over into the fear category right now. And this is not showing in extreme reading. If we were at a significant bottom right now, this thing would be pegged way over to the left-hand side in extreme fear. We've seen that earlier, and that did suggest that we would see a rebound. But on a sentiment level, people are pretty confused right now. They're finding it a little bit difficult to take a stand, at least the smart money. Anybody can make a stand and be right or wrong. It's just a roll of the dice with what a lot of people say. But there's a real shift going on because we're changing into a different environment as far as the stock market is concerned. And then looking at the chart, we're still midway. We've dropped a little bit more over into the fear side, but it's not any kind of an extreme reading right now. Then as far as the VIX, as we went down, the VIX continues to climb. This is a pretty high level for the VIX, but it's been at this high level before. Some of the sectors, and I changed this up a little bit, not this chart, but the next chart. The communications sector was pretty negative on Friday. And then some of the other weaker sectors are things that we've been seeing over the past week. Discretionary, now materials, which is more of a value play, that also was down on Friday. So we saw more of across the board. Financials, again, another tendency to be a value play. Techs got slammed again. Energy, which had held up fairly well, it got hit. The only sector that was positive, and that was just by a little bit, were these staples, things that you have to have no matter what's happening in the economy. So it was a pretty much across the board selling on Friday. And this is what I've changed up a little bit. I'm trying to organize this. Instead of going back to the first of the year, I'm just about at the first of the year, but I'm going back to the recent high in the S&P just to see how the sectors have been performing since that. And each day I'll adjust this chart, and then I have it organized from high down to low. But the energy continues to do the best overall, way over on the left. Take one videos, and then way over on the right, the discretionary, the thing, the extra car, the gym memberships, the boats, the RVs, things that are really nice to have, but people don't have to have just to live. That's seeing some more weakness so far since the recent high. As far as inflation, we're looking at the BDI, which again, surprisingly continued to fall. We're seeing a real significant decline in this index. Again, we're trying to play out the scenario. Does it mean this indicator is useless and not really helping us? Or does this mean inflation is not as bad as it's being portrayed? Fed Watch, I updated these charts. We do have the Fed meeting this coming week, and there's a 95% chance that they're going to keep interest rates where they are right now. It's later on in the year that's starting to get some attention. And this continues to go up as well. For their March meeting, there's an 88.7% chance that they will raise interest rates. And even though this is not going to catch us by surprise, you might want to get things ready now, especially if you have longer term strategies where you're doing iron condors or credit spreads. Beware if you go further out in your calendar that this is going to happen, and people are going to freak out even if they know it's coming. And so that could really dig into some of your strike prices if you go that far out into the future. Now, if you close everything out before that, no problem. But if you're going to try to ride through the March meeting, you may want to take some more defensive measures or consider closing out before that meeting. Then in May, we're about even, except we're seeing a little more push towards 0.5 to 0.75% at that time. And then in June, we're kind of across the board. This is like the weather. It's really a lot more predictable to predict. Okay, let me back that up. It's easier to predict the weather tomorrow and what the weather is going to be like than what it's going to do a week from now or 2 weeks from now. You can really only guess. There are probabilities of what the weather will be like, but as you get closer to that day, you'll have more of an idea of what will really happen. The same thing is true here. We can project out into the future, but this changes all the time. And as we get closer to these meetings, will be more and more of what is likely to happen, or closer to what will happen. Another thing that I meant to include on my other videos that I had forgotten about is a thing called technical alerts. And these are just mechanical alerts that are generated across the wide variety of technical alerts. They're just mechanical. And I usually only focus on the S&P 500 alerts, but this also gives us a list of anything that has happened. For example, at the top, the S&P crossed below 4,400 on Friday. That was a technical alert. The NASDAQ crossed below 13,800. And looking down here, S&P 500 bullish percent index crosses below 50. And that's pretty much it. The TSX at the bottom, that's Canada. I just go ahead and include that because there are neighbors to the north. But this is a pretty interesting thing just to keep an eye on, and it gives us more of an intermarket view of things. Then the intraday chart. So here, way over on the right-hand side, we did gap a little bit lower and we went down all the way to S1. And then we tried to rebound up to the unchanged level, which acted as resistance. We fell back down to S1, danced along that for a while, and then going into the close, we saw renewed selling. And then we closed pretty much at the low for the session on Friday. Here's what we look like. Here's what things look like on a daily chart. I changed this up a little bit. We're not seeing a series of higher highs and higher highs and higher lows. That has been broken now. And I did have a different trend line, kind of a pseudo trend line going up here. Well, we broke through that. And so we're now below short-term support and we're heading down to S2 on the daily chart, which is recalculated every month. So we're kind of getting near, again, another place where if the S&P and some of the other indexes are going to make a stand and use support as justification for getting in and all the algorithms to kick into gear, something's going to need to happen if we're going to bounce from here. And then I drew another line where we go back to the October lows. That is kind of the next area of support, at least on the S&P 500. We can get other areas in the Dow, the mids, the small caps, the NASDAQ, so forth. I'm just looking at potential support areas on the S&P for this chart. Oh, and then one more thing. We were quite a bit above average on Friday as far as volume because of options expiring. Another chart that I'm starting to include is when we start to hit a new high like we did in early January and then fall back, I'm just going with the retracements from the high. How far have we fallen since we hit that high? After Friday's close, we're down 8.73%. Looking at the growth stocks are continuing to show weakness. All I do is I take the growth ETF and divide it by the value ETF, and I get that top chart, and it just shows the growth is going down. I do the reverse of that on the bottom chart. I take the value ETF and divide it by the growth ETF, and it's showing how value is improving. As far as our trend, we are in a trend now. We have crossed above 20. So if you're more conservative using the ADX, this is your trigger line. Now, we've fallen quite a bit already. And like I'm saying, the charts show that we might have some kind of a bounce. So you might be a little bit leery of that. One of my personal rules, except for time, and if you can hear coughing in the background, I forgive that, and please forgive me for that. I'm not in a real recording friendly place right now. There's also a cat that likes to get some attention from time to time. But the problem that we're running into is when you do time-based strategies where you're using time decay, we don't care when we set up those positions. We want to get in when we get in. Well, if you're in trend-based systems, a rule that I have is when you're looking to go long, and everything's set up for the market to go up, you only enter as close to the close as possible, and if the market is up. Now, a lot of people don't agree with that, and I understand why people take the opposite of that. I just totally disagree with it. And I believe that's why most traders fail, because if you want something to go up, why in the world are you going to buy it when it's going down? Because things might have changed and the whole climate might have changed. I also like to do things as close to the close on a trend basis, because there's this adage, and you'll hear me say this in my classes and throughout these videos, it's the amateurs that open the market, it's the professionals that close the market. And so we want to get as close to the close as possible. Yeah, there are times when we miss part of the move, but what we're looking for is not so much to get every point we can. We're looking to make sure that once we get into this trade, there's a higher probability that it's going to do what we want it to do. And then using the ADX, we're showing kind of an extreme negative reading right now. So even this, I don't use this as an oscillator, but looking again over the last year, when prices have gotten up to where they are now, which we didn't over the last year, usually that means some kind of at least going sideways, if not some kind of a rebound. But we are in a downtrend right now. As far as the breadth, we're negative overall. Based on price, based on volume, we're rolling over based on price and volume, and we continue to be below the moving average on volume. So things are pretty stinking negative right now. Doesn't mean they will stay that way, but they are right now. The ratio that we look at, again, we're starting to get down to a significant negative reading. The last time we were even close to this reading was during the COVID plunge. We haven't been this low since then. So another reason to think that maybe we have fallen too far too fast. Also, the new highs and new lows, they're really trailing off, and we're starting to see a real pickup in new lows. This chart also confirms that, as is the 10-day moving average. It continues to go lower. In the short term, this is what we've been seeing all along. As prices continue to fall, the 20-period moving averages are rolling over with the blue line below, since that moves faster. And so that is negative also. Our other, okay. And okay, sorry about that. It's really hard for me to see some of these charts. They look kind of small and I try to see the writing and I need a magnifying glass because I'm using different software. The 20 period moving average, yeah, we're getting to an extreme reading, but it could go lower. Intermediate term, we're going down, and the 200 is really rolling over as well. Then this is another moving average chart. There's a big debate that goes back and forth. Are simple moving averages or exponential averages better? And in my class, I have a story that I tell, and it's all interesting, and people find that fascinating. I plot them both. I'm not looking for magical indicators when it comes to technical analysis. You'll notice that most of my indicators are out of the box. I use the default settings. Why? Because millions of people do that. And this ends up being like a self-fulfilling prophecy. So instead of trying to find something that gives us insight that other people don't necessarily have, I'm looking at what a lot of people and a lot of these algorithms out there, what they use, because they program this in that when certain things happen, you buy or sell. But over here, this is what I'm saying. We fell through the 200 simple moving average on Friday, and we closed right at about the exponential moving average. So we're not even in no man's land right now. We're right here. So if we're going to take a stand, it's probably going to be here. But notice back here in October and into late September, October, we actually broke below this. And it ended up being a fake out. Now, we were in a slightly different environment then. We weren't as worried about interest rates then as we are now. Well, now we'll have to see. Are we going to break down below this, or are we going to find some support and be able to bounce up off of that? The MACD is negative and pretty extreme right now. The short-term Swanland oscillator, it's showing an extreme negative reading based on price, and we're down significantly based on volume. The McClellan oscillator, yeah, it's more negative than it's been in a year. The Stoke RSI, it continues to be pegged near the bottom, and it can stay that way for quite a while. That's why it's not one of my favorite indicators. I thought it was great when it first came out, but then it just, when it stays either extreme, positive, or negative, what good does that do me? Then some of the rate of change charts that I talked about and included on Friday, we're showing an extreme reading based on the 5-period rate of change, also extreme based on 10 periods, and on the 20 period, as well as the 150 period, so a little longer term. This is starting to register some signals. And then even the 200 period rate of change, it's dropping down to a pretty extreme reading right now. Standard deviation, this was up on after Thursday's session. Well, because of the decline and because we're going pretty fast and closing near the lows, this continues to climb. And we're getting back to more of an extreme reading based on what has happened over the last few years. The %B, which these are Bollinger Bands on the top, and when we're really skirting down along the left band or upper band or lower band, I mean, we're going down so fast, this looks like a left band right now. We're showing a pretty extreme reading. So there's a lot of evidence that people could use to justify at least a short-term rebound. As far as the intermediate term, 50 period, yeah, we're continuing to roll over as far as the both moving averages here. Then the PMO, we're showing an extreme reading overall. We're getting to an extreme reading based on price, and we're clearly negative based on volume. The other PMO study, where the PMOs that are rising, that's extreme negative. We're getting close to the point where we're seeing an extreme reading negative as far as buy signals for the PMO. And then those PMOs that are above zero continues to taper off. And I even saw this noted in some of the things that I read. The bullish percent index has now gone extreme negative. Our rainbow, although it's still holding up, we're seeing the fastest moving average begin to roll over. They're not really jumbling into the other moving averages yet, but we're just slicing through all of these moving averages right now. And if this continues, you're going to start to see this pretty little rainbow turn into more of a twisted ribbon. Stochastics, short term, oversold. Intermediate term, oversold. Longer term, getting oversold. The vortex, again, it continued to go up. And we're seeing an extreme reading with the green going down right now. We're not necessarily seeing an extreme reading with the selling. So that could continue to advance. Summation index based on price and volume continue to go down. All of our different momentum oscillators, some are showing extreme readings pretty much across the board now. And I have a couple other ones. What I do is I put all these on one chart and I glance at all of them. But then every once in a while, I'll take one of these and pick them out and show that as an individual chart. And I'll do that with a few of these later. The Chaikin money flow, which had gone negative on Thursday, well, with the selling on Friday, it's now more decidedly negative. And we could go a little bit lower, but this could also mark some kind of a short-term bottom. CCI continues to be pegged negative. Williams percent R continues to be pegged negative. The ulcer indicator, well, as prices continue to fall, that's more and more fear since most people are geared for the long side in the market. So you see fear really starting to go up. Longer term, yeah, we've gotten higher than this before, but based on 2021's readings, this is as high as it's been in over a year. The Copic indicator is starting to show more of an extreme negative reading than longer term. Yeah, it could go lower, but the last time it went lower than this, well, it was throughout 2020. We had a couple of pretty good low dips, but it really got down there during the COVID plunge. Everything went down during that plunge. That's probably why in fact, that is why we saw such a fervent rebound after that, because everything went down. Then this other one that I'm playing with, the boom indicator, based on the MACD and a PPO, we're showing an extreme reading on both of these. And then this bottom indicator is also starting to come down from a pretty high reading. This is another one. I look at this every day, but I don't always include it. This is the Sean Trend Meter. This is a book that came out, my goodness, a long time ago, back in the 90s. One of my favorite books. I don't even know if it's available anymore, but one of the authors has some pretty unique indicators that I now have access to. Well, this is a conglomeration of different indicators used together. And you can see for most of this time, we're pegged in the nicely uptrend area. And then we see an extreme reading to the upside. Well, for the first time in quite a while, we're starting to get close to an extreme reading to the downside. Doesn't mean it can't go further down, but it's a lot different than what we have been used to for the last year to year and a half to 2 years. Here's the RSI. I know people love the RSI, and it's one of the first oscillators that everybody learns. I'm not a big fan. You can tweak it and have it do what you want it to do, but about the time you perfect it and modify it, it's about the time the market changes its environment, and all that tweaking that you did doesn't really help you all that much. That's why I use a lot of out-of-the-box default settings. But we're showing an extreme negative reading, but it could go lower. This is another one of the momentum oscillators. This is slope. This was also developed by Sean. And we're showing more of an extreme reading right now. Where some of the indicators that we use, like the ADX, it will tell us the magnitude of the trend. It doesn't tell us the direction. Well, slope tells us the direction. This is another one called Special K. Some of you probably eat this for breakfast. This is a longer term, it's a little slower. When I bring up the all world indexes that I look at, nope, that's incorrect. I use a different indicator for that. But this doesn't change very often. This is an oscillator that doesn't, you might only get a few signals a year, if even that. So I brought this up longer term, where you can see we went down with the COVID plunge. We came back above the moving average, and we've stayed above that moving average until now. We're starting to break below that. So this is a kind of a big signal because this is a longer term indicator. And then another thing, I ran across this indicator a long time ago. It's called the ultimate indicator. I don't think it's very ultimate. There's a lot of times when I was hoping that this indicator would give me some insight, and it didn't. But now we're showing an extreme negative reading. This is a little longer term view of that same chart, just to give you some historical perspective. We haven't been down this low since the COVID plunge. As far as some of the trading systems we look at, Elder continues to be negative, and the MACD is showing an extreme negative reading. The SAR, stop and reverse, continues to be negative. And this picked up. One of the things I like about this is it picks things up pretty quickly. So if you had actually followed this in a more mechanical way, you got in. You would have been seeing some initial losses, depending on where your stop losses were placed, but you would have been in early during this downward move, but you would have had a couple of scary days. However, since then, you'd be looking pretty good right now if you use this. That's why I don't use one system. I take all the things together. Some of the different charts, the Heiken Ashi chart continues to show weakness. The Kegi chart is also showing weakness with this little red line coming down. The Renko, and I said it wrong in Friday's video, I called this the Kegi chart. This is Renko. It added another red box after Friday. 3-line break. It's trying to still figure out, okay, when are the 3 lines going to happen? We have 2, 4, 5 right now. When we turn and go to the upside, that will redraw this chart and show the actual break. The equivolume continues to show weakness, and the ease of movement indicator showing an extreme negative reading. And then this is one a lot of people love this, the Ichimoku cloud. Did I even say that right? I just call it the itchy cloud. But this is just a shifting of moving averages that can show you support and resistance. A lot of Forex traders really like to use this. I don't use it all that much. I look at it, I think it's kind of cool looking. But the thing that I notice is we have really dropped below the cloud right here, which is pretty negative. And if you look at what's happening, you're starting to see things begin to roll over. Point and figure added another 0 on Friday because of the continued decline. But overall, we still see a blue line at the bottom, which you draw that underneath uptrends. Longer term, and again, I address most of these in the weekly chart. And at the time I'm recording this daily video, sorry, my weekly video. At the time I'm recording this daily video, I have not recorded the weekly video yet. I'm hoping to post that as well. But we're seeing more of a tandem move between the S&P and the equal weight S&P. Broad market, as far as stocks, S&P is going down, the mid caps are going down after not seeing a confirmed high a few months ago. Small caps are really getting hammered quite a bit. This is just a longer term view of the same chart. Even though bonds, they declined, actually they went up on Friday, we're still not seeing a shift. And this is long term. My goodness, this goes back to 2012. So if you're going to allocate into stocks or bonds, you don't do this very often. The FANG stocks, yep, they're getting bit pretty hard. ARC, it was actually, well, it was down. It was actually down a little bit, actually down 5%. My goodness. It was down 5% on Friday. So Kathy's not currently the rock star that she has been. The Dow, we broke below the moving averages, and we're, at least as far as pivot and moving average support, we're kind of in free fall right now. It's a longer term view. Dow theory, we're seeing a decline in the Dow itself, in the trannies, and utilities, which typically hold up better because they're more interest rate. If the interest rates are going up, people like utilities better because they tend to pay high dividends that match interest rates. Small cap, and for some reason I forgot to include that in some of my other videos, so I'm including that now. We're seeing real weakness after a lot of sideways trending has happened over the last year, and people were pointing this out, and I saw this, and yeah, it's something that we keep in the back of our minds because the S&P was hitting all-time highs. Well, you had the small caps just kind of trending sideways. Then the mid caps, kind of the same thing. They're breaking down, and we have a bit further to go until we get to S2. The NASDAQ, yeah, it's breaking down pretty significantly right now. And then we have the NASDAQ 100, the same thing. We've even broken below S2. So I'm going to have to put an S3 on here, it looks like. The NYSE, which had been up, holding up better, it actually fell a little bit below S1 on Friday. Wilshire also showing some real weakness. This is the technical picture that a lot of people are seeing, and they don't like it, and they're starting to get pretty nervous. That's why you see hedging going up if people want to stay in the market, or you're starting to see a lot of selling if people want to get out of the market. Here's a longer term view where we have broken below the 200-day moving average. All stocks, yeah, this held up. And I pointed out in Friday's video, if we were going to make a stand, this would be a good place to do that. Well, no stand was made, or the stand failed. So we've now dropped below this 200 period moving average. This is the other indicator, and this is called the KST, where we're still, and this is slower. So you're starting to hear things. I was reading something a little while ago where, oh yeah, international markets are crashing. You have Russia, you have Turkey, you have, I don't know, Bolivia or something. Those stock markets are not that important. They don't lead the world in things. It's one of my doom and gloomer people. And they always look for any kind of evidence that we're just going in the toilet. And if you look hard enough, you can always find it. And some of these folks, they find it, and they use that as justification for the end of the world. Well, I look, at least when it comes to world indexes, I use a little longer term oscillator. So China, it had a pretty good day on Friday. The emerging markets, yeah, they've been holding up fairly well. So Asia is doing better. Europe just got hammered on Friday, and we're seeing a continuation of more of a sideways pattern. Japan, yeah, starting to roll over a little bit. Hong Kong's having some real trouble right now. And then the S&P is starting to roll over. So we're not seeing an across the board confirmation, at least as far as world indexes are concerned. As far as the broad market, other things that we look at, copper continues to chop sideways. And then people are all concerned that gold is breaking out. I'll show you that in just a minute. After really having a difficult time earlier in the week, the dollar has been holding up fairly well. Then here's the weekly chart where we close just a little bit above this 13 period moving average. This is a weekly chart, and I switch the numbers of the moving averages for these longer term views. Lumber, I've been liking to keep an eye on that lately. I added some little messages here. We fell down, and then we've been going up through a strong climb. Well, we're starting to see this trail off a little bit. Oil, Some people that I listen to, they're predicting 100, $110 a barrel here pretty soon. And that may happen. We were down a little bit on Friday. We're about in the mid 85s, which you're really feeling at the gas pump. Gold, it's like, yeah, gold's ready for the breakout. I don't see a breakout here. I love gold, don't get me wrong, but if you're more of a trend-based investor, you're not seeing anything that's all that spectacular yet. Now, if you buy gold just because gold always has value and you don't care what the price is, fine. But if you treat it more as an investment or as a trade, we're not really seeing much right now. And they've been predicting this for years now, only to have it not happen. So what I do is I look at the charts to tell me what's going on. Silver, yeah, we went right up to the 200 period moving average and then saw a decline on Friday. CRB, it was down a little bit on Friday, but overall, we're in a pretty strong uptrend. And this is what feeds through to inflation in many ways. Then this is another new chart, and I'm going back about a year on this just to get some perspective. This is what I call intermarket analysis, and I rely on that heavily. And I just show, okay, this top one, this is oil. Yeah, it's been doing really well. We're up over 70% going back to the beginning of 2021. And then the S&P, we're trailing off now, but it had been performing quite well. Here we have the dollar, which is showing about a 5% gain overall. TLT is the 20-year bond ETF. That has been declining. And then gold, I tried to make it the gold color here. That's down closer to the bottom. This just goes back to a point in time and measures from that point. It doesn't measure from a significant bottom or top. This just gives us an idea how over the last recent period of time, how have these things been performing? Then I'm also including, and I don't talk about this very much. This is a Bitcoin chart, and I'm really showing it just because we're seeing a real breakdown right now. My personal opinion was, and I've done some videos on this, and if you go to my YouTube and Rumble sites, you'll find some videos there. And this may end up developing into a head and shoulders top, where you have the left shoulder here, you have the head right here. Well, we're not even beginning to build the right shoulder yet. So that's kind of what I've been looking for. But in the meantime, Bitcoin has really been breaking down. I don't talk about Bitcoin. I love the technology, but I'm not an active participant in the market just because there are people that have no clue what they're doing, thinking they're all going to become rich. They're quitting their jobs. And that's every indication of a bubble. We saw this back in 2000 with the dot-com boom and bust. We saw this in 2007, 2008 in the housing crisis. Well, is that going to happen? I mean, there are still good stocks out there. There are even some good dot-com stocks. There are still houses out there. There are very good investments. Bitcoin itself, the technology is spectacular, but the market participants to me are what make this a real bubble environment right now. So I stay away from it, although I watch it closely. But we've actually been breaking down below 40,000 right now. And I did a video right when we were near the top in here, and somebody made a comment like, yeah, they thought I was slamming Bitcoin, which I wasn't. I was just saying, be careful. I did some videos right about in this area in here. And then anytime I would see a significant move, I would do another video. And somebody who obviously didn't watch the video thought I was slamming it. And they're saying, oh, what do you have to say now? Well, that was right here at the top. And I'm like, yeah, at this point, the technicals look strong. Well, see, the markets have a real way of humbling people. Just about the time you think you have it all figured out and that that it's easy all the time and you're just naturally going to make lots of profits, that's when things have a real tendency to shift and go the other way. And I deal with this a lot in my classes. Okay, let's look at bonds where we actually saw a decline in yields pretty much across the board on Friday. And then we saw kind of a detraction of the yield curve. People read a lot of secret meaning into all this movement. I keep an eye on it each day, but I'm really only concerned with the overall direction. And then when we get down to the inverted yield curve area. Looking at some world interest rates, US is still number one, saw a bit of a decline on Friday. The UK, Japan was down, and Germany remains slightly negative. The World Bond Index is really showing continued weakness overall, even though it was up a little bit on Friday. As far as the economic calendar, this is new, and I'm gonna have to make this a little bigger. My goodness, it was taking me an entire afternoon just to prepare a spreadsheet for the economic calendar. So I'm using some different sources and trying some things differently. A lot of this is going to look different than what you saw last week. I'm more copying, pasting right now than actually trying to build a spreadsheet. This will get more filled in as the week goes. And as we go through each day, this chart will be updated for that day's video. So this just shows you what is coming out in the coming week. One of the important things is we're getting GDP this week. And then the Fed is, let's see, GDP comes out on, I thought it was Thursday. And somewhere in here is GDP. Yeah. But then the big thing too is the Fed will be coming out and there'll be a press conference after that on Wednesday. And the market likes to dive into that, fixate on it, try to find secret meaning in all those words. Okay, so the conclusion from Friday, we're in a downtrend. Yeah. Short and intermediate term are negative, but oversold. Intermediate term is becoming more and more oversold. The long-term bias does remain positive. For Monday, we are in a downtrend, but oversold. Yeah, I thought we might get a bounce on Friday. They tried, but it didn't really materialize. We might see some kind of a bounce on Monday. We'll see if it holds up or if this environment is changing so much that any strength is seeing selling. The Fed is meeting this week. We're still in the middle of earnings season, and then the geopolitical events that may be developing between Russia and Ukraine. So thank you very much. I hope you're having a nice weekend, and I'll talk to you again on Tuesday. Now I have to figure out how to turn this off.